I think there's two critical paradigm shifts in this last 12 months that you have to take into account. The first is a macroeconomic paradigm shift. The cost of capital has exploded from 6% risk-free cost of capital to 20%. Maybe the S&P was yielding 8%, and then it starts looking like it's yielding 24%. So the cost of capital tripled, and that's kind of like the broad money supply inflation rate. So the amount of money is being pumped in the economy tripled at an annual rate. So that has broken a lot of conventional investor models, a bunch of conventional treasury models, and a bunch of conventional strategies. And it's macroeconomic change. Somebody said, 40% of all the money, printed in the first 240 years of the country, right, got printed in the last 12 months. So maybe you divide that over 2 years instead of 1 year, but that's the first big trend, the rate of monetary inflation. Mm-hmm. The second big, the paradigm shift is the formation of $1 trillion global monetary network, which we call Bitcoin. Bitcoin is the first digital monetary network in the history of the world. So for 5,000 years, we never had a sound monetary asset circulating on an open computer protocol. And so there's nothing to look back on. The closest thing we had was the gold standard, and that was a sound physical asset circulating in space. And so the idea that I'm going to actually take a $1 billion of money and put it in gold and move it around, that's 30,000 pounds of gold moving around. That's an idea that we had for thousands of years. And somewhere in the 20th century, it became antiquated and just too heavy and too cumbersome to work. And so, the gold standard got abandoned for fiat. Well, in the 21st century, we figured out how to put $1 billion block of money into virtual gold in cyberspace and then move that around. And we can move that around 1 million times faster and 1 million times smarter than we could move the physical gold. So I call these both paradigm shifts because, we never in modern history had a situation where the cost of capital was so extreme. And we never in history had a situation where we could actually store monetary energy on an open global digital network. And those two things cause you to reassess your strategy as a corporation or as an investor or just as an individual.
Yeah. So I guess the confluence of those two paradigm shifts is that everyone is looking for an optimal store of value asset, right? Because like you mentioned, 40% of all the money that's ever been printed has happened in the last 2 years. So that's caused people to say, hey, and how I've heard you describe it is you're sitting on a melting ice cube, so to speak, right? Or frogs boiling in water, or pick whatever metaphor you want. But however much money you think you have, that's slowly disappearing, right? And you have described also kind of the world of investable assets or store of value assets. It's roughly a $350 trillion market across things like stocks, bonds, real estate, other kind of traditional store of value assets. How do you see the market for these, fiat denominated or fiat derivative assets changing over the course of the next 20 years?
I think that if we start with a fundamental premise, the fundamental premise is that as the rate of monetary inflation increases, it skews the entire playing field, or it tilts the balance of power in favor of scarce assets that are not valued based upon future cash flows, to the detriment of assets that are valued based upon future cash flows. So the fundamental challenge for a corporate treasurer today is, it used to be, if I had $1 billion and the money supply is expanding at 5%, and I could invest in debt yielding 5%, then maybe after tax, if the after tax yield is 3%, I have a negative real yield of 2%. And so in that kind of world where I have a negative real yield of 2% or 3% or 1%, I have 30 years before I substantially destroy my asset or my purchasing power. The negative real yields have exploded. If you're looking at the real yield versus the monetary inflation rate, and now the negative real yield looks like minus 10% or minus 15%. For people, and I think you have different types of people, by the way, those that fixate upon inflation equals CPI don't see this, because CPI is a misleading measure of inflation. CPI is only measuring the rate of consumer price inflation. It isn't measuring the rate of asset inflation, and it isn't measuring the rate of elite price inflation. Houses are inflating at 15%, but rents are inflating at 2%. But Hampton's houses are inflating at 35%. So you've got multiple inflation rates. If you calculate real yield based upon CPI, there isn't much of it. The negative real yield is going to allow you to live with the problem for 20 years. And so you're going to wait. If you calculate the real yields on your assets with monetary inflation, the negative real yields are the lowest, right? They're the most extreme in our entire lifetime. And so now you can't wait. If once you see that, then you look at the $350 trillion worth of assets, and what you see is that conventional treasury strategy, right? If I'm just holding cash, I've got a negative real yield of, say, minus 15%. If I'm holding cash in short-term treasuries, well, they're all yielding effectively nothing. So your negative real yield is still minus 15%. This is assuming you assume you have 15% monetary inflation for the next 4 to 8 years. So conventional treasury strategies now have this problem, because the negative real yields have gone from minus 2% to minus 15%, maybe minus 20%. That means that capital or cash equivalents on the balance sheet is now toxic. The toxicity of the assets is a function of the rate of monetary inflation. So if the central bankers are if they're inflating the money supply by 15%, then they're sucking 15% of the energy out of the cash and out of the treasury assets. And pretty much every corporate treasury in the world is either holding cash or they're holding treasuries or corporate credit grade debt that's like got a duration of less than 5 years. And all of that stuff, in essence, has negative real yield minus 10 to minus 15%. So what you have is a challenge there, but the bigger, and this means that if you're a corporate treasurer, if you're a corporation, since your entire investment portfolio is cash and cash equivalents, you're sitting in a world where you have negative real yields of minus 15%. It's toxic. You're going to cut your purchasing power or your shareholder value in half in about 4 years. Right? So $100 billion at Apple Computer, you're going to have $50 billion of shareholder value loss in 4 years. That's their problem. Investors in general, they know that it's not a viable strategy to invest in cash or short or long dated sovereign debt, right? Cash is trash and debt just doesn't work. So they've stampeded from that. And so the first stampede was, the obvious stampede is into equities and generally ETFs. And so you have people looking as a store of value to equity instruments or maybe to real estate. But the problem is real estate looks just like a long bond. You've got a 10 to 30 year, you've got a long-term lease, it's CPI capped. If the lease cannot be renewed at a price greater than CPI, then you're going to have monetary inflation rate of 15%, CPI inflation at 2%, negative real yield minus 13%, which means, again, the ability of a consumer of a commercial piece of real estate to hold value is impaired as the inflation rate of the money supply goes through the roof. That takes you to equities. And for equities, the problem is that value stocks are low growth stocks that are based upon reliable cash flows. What I did at DuPont was I just modeled the discounted value of the cash flows. And it's a simple equation. When the discount rate gets to more than 15%, then future cash flows start to be worth nothing.